Hey everyone, welcome back to the channel. Today, we're tackling a surprising question that challenges what most of us have been taught about money. Could traditional saving be making you poorer? If you've been following the age-old advice to save, but haven't seen your financial situation improve much, then you're not alone. Many of us grew up hearing that a savings account is the best way to secure our future. But in today's economy, is that really true? Could it be that traditional saving practices are actually setting us back instead of propelling us forward? Today, I'll be breaking down why traditional saving might not be the golden ticket to financial success and what you can do instead to truly grow your wealth. Stick around because by the end of this video, you'll have a whole new perspective on how to manage your money effectively in the modern world. The truth about savings accounts. All right, let's start with the basics. Most of us were told to save money in a bank account. Whether it was a piggy bank as a kid or a savings account as an adult, this idea is embedded in our minds. And yes, it does sound like responsible advice. But here's the catch. While it might be safe, it's not always the smartest way to grow your money. In today's world, the average savings account offers an interest rate of, let's say, around 0.5% to 1% annually. So if you have $10,000 in savings, you might earn about $50 to $100 a year in interest. Now let's put that into perspective. Is $50 to $100 going to make a big difference in your life? Probably not. What makes it worse is something most people overlook: inflation. Inflation is the gradual increase in the cost of goods and services, and it's been particularly high in recent years. So even though your savings balance might be slowly growing, the purchasing power of that money is shrinking. For example, if inflation is at 3% and your savings are growing at only 1%, you're actually losing 2% in purchasing power each year. This means that over time, the same amount of money in your savings account will buy you less and less. Essentially, by keeping your money in a traditional savings account, you're almost guaranteeing that it will lose value. Why saving alone can't build wealth? The next point might surprise you. Saving alone won't make you wealthy. You could save a portion of every paycheck for decades and still find yourself short when it's time to retire or make a big purchase. Why? Because wealth isn't just about saving, it's about growing your money. Wealthy people don't just let their money sit, they make it work for them. That's why you hear so much about investing. Saving is a passive approach, while investing is active. It's about putting your money in places where it has the potential to grow significantly far beyond what a savings account can offer. For instance, let's compare two people, Sarah and Jake. Sarah saves diligently and builds up $100,000 over 30 years in a savings account. Jake, on the other hand, chooses to invest that same amount in a diversified portfolio of stocks and bonds, averaging a return of around 7% annually. After 30 years, Sarah's savings might have grown slightly, but Jake's investment could be worth over $750,000. That's the power of growth. So if your goal is financial freedom or wealth, saving alone won't get you there. You need to think beyond the savings account and look at ways to grow your money actively. Understanding good saving versus bad saving. Let's clarify something important here. Saving isn't all bad. There's a big difference between good saving and bad saving. Knowing when and how to save is key. Good saving is about setting up an emergency fund, something everyone should have. This is money you set aside for unexpected expenses, like medical bills or car repairs. A good rule of thumb is to keep 3 to 6 months worth of expenses in a high-yield savings account or other liquid, easily accessible place. This fund gives you peace of mind and protects you from having to dip into investments or go into debt during emergencies. Bad saving, on the other hand, is when you put all your extra money into a regular savings account with the hope that it'll grow over time. This approach leaves you with a huge opportunity cost. Every dollar that just sits there could be working for you elsewhere, potentially earning a higher return. So remember, An emergency fund is essential, but beyond that, consider how you can make your money grow. The inflation trap and why it's getting worse. Let's dive deeper into inflation, because it's a critical factor in understanding why traditional saving isn't enough anymore. Inflation typically rises around 2 to 3% each year, but as we've seen recently, it can sometimes spike much higher. When that happens, your purchasing power drops even more rapidly. Think about this. If inflation is at 5% and your savings account is earning 1%, your money is losing 4% of its value annually. Over a decade, this would significantly reduce what your savings can buy. This is why the wealthy often avoid keeping large sums in savings accounts. Instead, they put their money in investments that have the potential to outpace inflation, like stocks, real estate, or even certain bonds. And here's something important: not investing is a risk in itself. By avoiding investment because it feels risky, you're actually taking on another kind of risk: the risk of inflation eating away your hard-earned money. Alternatives to traditional saving. So, if a traditional savings account isn't the best place for your money, what are the alternatives? High-yield savings accounts offer a slightly higher interest rate than a regular savings account. While they still won't make you rich, they're a better option for your emergency fund since they can earn around 3 to 4% interest, helping you keep up with inflation. Certificates of deposit can offer a higher return than traditional savings accounts, but require you to lock up your money for a set period. They're not ideal for long-term growth, but they're a slightly better alternative if you're looking to park cash safely for a few years. Investing in stocks and mutual funds is one of the most effective ways to grow your money over the long term. Yes, they come with risk, but historically, they offer much higher returns than savings accounts. Start small if you're new to investing, and consider low-cost index funds for broad market exposure. Buying property can be another way to outpace inflation. Real estate has a history of appreciating over time, and it can provide passive income if you rent it out. Keep in mind that real estate requires a larger initial investment, but it's one of the most stable wealth-building strategies out there. If your employer offers a 400-on match, take advantage of it. These accounts are tax advantage, meaning you don't pay taxes on your contributions right away, allowing your money to grow faster. Additionally, IRAs offer tax benefits for both traditional and Roth accounts, which can help you build wealth long-term. Bonds and Treasury inflation-protected securities are safer options for people looking to preserve capital and beat inflation. TIPS, for example, are government-backed securities designed to keep up with inflation, making them a better alternative than traditional savings accounts in high-inflation environments. Shifting to an investment mindset. This brings us to perhaps the most important point: shifting from a saving mindset to an investment mindset. Many people feel scared to invest because it involves some risk, and we're conditioned to think that losing money is bad. But here's the truth: not investing is riskier in the long run. Imagine planting a seed. If you just leave it sitting on the counter, it'll never grow into anything. But if you plant it in soil, water it, and give it sunlight, you might end up with a tree that bears fruit for years. Investing is like planting that seed. You're giving your money the chance to grow and work for you. Start by educating yourself. There's a wealth of information available online, from articles to videos to free courses. Learn about the basics of investing, the types of assets you can invest in, and which options align with your financial goals and risk tolerance. Taking action. Start small, but start today. The biggest barrier to investing is often just getting started. You don't need thousands of dollars to begin. Many platforms today allow you to start with as little as $10. The key is consistency and learning as you go. For example, you could start with an index fund or a diversified mutual fund. These funds spread your investment across many different companies, lowering risk and getting you exposure to the broader market. Over time, as you become more comfortable, you can explore other investment options. Set a small goal, like investing $100 per month. This may not seem like much, but over time, and with the magic of compound interest, it can add up significantly. So there you have it. The reasons why traditional saving might actually be making you poorer, and some practical steps you can take to build wealth instead. By shifting from a saving mindset to an investment mindset, you're setting yourself up for a more financially secure and prosperous future. If you found this video helpful, don't forget to hit the like button, subscribe for more content like this, and let me know in the comments. What's one investment strategy you are interested in exploring? Remember, financial freedom starts with making informed choices. So keep learning, keep growing, and I'll see you in the next video.